Assalamualaikum once again. So continuing with section 80 of the insurance code, let me first ask you with the question, can a person be entitled to a return of the premiums? Now, the answer to that would be no, or the general rule is that um, uh, the insured or the person who made such premium payments is not entitled to return thereof. Why? Why is that so? So the very purpose of insurance is the assumption that there is risk against the thing or life being insured of. Otherwise, it is a futile business. So precisely is the fact that the insured is not entitled to a return of the premium payments he had made on the insurer because these premium payments is or are the consideration he exchanges consideration he exchanges in order for him to be qualified of the indemnity or to be the possible recipient of the proceeds of the insurance upon the happening of the contingent event or the peril insured against. So precisely that is the reason. But this rule admits of exceptions, which as you can see in this slide, we have 6 exceptions. Number one, if the thing insured was never exposed to the risk insured against. Number two, when the insurance is for a definite period and the insured surrenders his or her policy before the termination thereof. Number three, when the contract is voidable due to the fraud or misrepresentation of the insurer. Number four, where the contract is voidable because of the existence of facts of which the insured was ignorant without his or her fault. Number five, insurer never incurred liability. And number six, where there is overinsurance. Now, we will be discussing each of these exceptions in the following slides. So for the first exception, in paragraph A, section 80, it reads that if no part of his interest in a thing insured be exposed to any of the perils insured against, then the person insured may have or has a right to the return of his premium payments. Now, in attacking this provision or in understanding this provision, one must be able to identify whether the insurance contract or the insurance is divisible or indivisible as basically what qualifies as what qualifies in this provision or what this provision pertains to are those of insurance contracts where uh, it has divisible or distinct insurance insurance value or insurance. So as in this illustration, suppose the insurance procured by X upon his vessel contemplates a vessel or a voyage in three different stages, from port A to port B, then to port C, and to port D, and X paid a different amount of premium as regards each portion. In this case, the contract of insurance is divisible. So notice that we have three different or separate distinct insurance coverage in this problem. We have insurance coverage from port A to B, then from insurance coverage from port B to C, and then insurance coverage from port C to D. So these three distinct these three distinct uh, insurance coverages compose or comprise the whole insurance, which is actually or which we can classify as divisible insurance. So the effect is here. If X cancels the policy after he reaches port A, he can recover the premiums corresponding to the other stages of the voyages as to which new risk has been assumed by the insurer. So to elaborate more, the illustration tells us that upon such time that the insurance or the insured thing has been exposed to the peril insured against upon its voyage from port A to port B, then that particular insurance coverage, the insured may no longer recover his premium payments. But on the other two distinct insurance coverages, insured may still recover the premium payments he has actually paid to the insurer. Now, critical critical is when the problem is composed of an indivisible insurance. So basically, there is only but one insurance which cannot be separated, or which is not distinct, or which is really an insurance that cannot be divided into different parts. So this type of insurance is not covered under the exception provided for in paragraph A, section 80. So basically, when the indivisible insured thing has been subjected to any peril insured against in the policy, then uh, the insured person cannot recover on the premium payments he has already made. Now, for the second exception, wherein the insured person may recover on the premium payments he has made, Section 80, paragraph B provides that when the insurance is for a definite period and the insured surrenders his or her policy before the termination thereof. Now let us first read the illustration. X insures his house for 1 year and pays the amount of 16,000 corresponding to the premium for 1 year. If after the lapse of 3 months, X surrenders his policy, he shall be entitled to collect 3/4 of the premium paid, or 12,000, representing the portion of the premium for the unexpired period of the policy. So this particular exception is where or can be seen when the insured person pays has prepaid the annual premium of on his insurance policy, his or her insurance policy. Now, say for example, as in the illustration, we can learn that only those upon such time that the insured person has surrendered his policy before the expiration of the insurance policy, then he can recover on the of uh, unexpired portion of the premium, representing the unexpired period of the policy. So that is easily understandable naman. Now, suppose that the insurance of the house also covers furniture, some of which were burnt prior to the cancellation of the policy, and the insured paid the amount of 4,000 for the damage. So to arrive at the amount recoverable by the insured person, first we must deduct the damages from the premium payment he has made, and then multiply again the prorata of the unexpired portion versus the whole period, and we'll get the value of the premium that is entitled to, the amount of the premium that the insured person is entitled to. Now, note that in this particular exception, the insurance must be for a definite period. So if the insurance is not for a definite period, then the insured person is not qualified or is not entitled to return a return of his premium payments if he so ever surrenders his policy. Another condition is that where a short period rate has been agreed upon. So where a short period rate has been agreed upon, then that short period rate will be the basis for the computation of the premiums that the insured person will be entitled to. And another and the last condition is that this is not applicable in life insurance policies, as life insurance policies are indivisible insurance policies. Okay. Section 81. If a peril insured against has existed and the insurer has been liable for any period, however short, the insured is not entitled to return of premiums so far as the particular risk is concerned. Now, this particular provision uh, provides us with the general rule that the insurance granted is the entire consideration for the premium received. Then, thus, or hence, if the risk has attached by reason of the contracts becoming binding upon the insurer, the whole premium must be considered as earned and therefore cannot be apportioned in case the risk terminates before the end of the term for which the insurance was granted. Thus, in the absence of any agreement to the contrary, if a peril insured against has existed and the insurer has been liable for any period, however short, the insured is not entitled to return of premiums so far as the particular risk is concerned. So that's the provision itself. So to understand more, um, let me give you an example or read you an example. X procures insurance upon a certain vessel against the peril of the sea for a voyage from Manila to London. The voyage is to last for 5 days. If X cancels the policy 2 days after the voyage has commenced, no portion of the premium is returnable because the thing insured has already been exposed to the peril insured against. So notice here that in this provision, it speaks of insurance policies which are indivisible. So, as discussed earlier, upon such time that the indivisible insurance insured uh, upon such time that the insured thing under an indivisible insurance policy has been exposed to a peril insured against, uh, it is insured against, then automatically the insured person may not recover the premium payments he has made, no matter how short the period has lapsed from the time of the prepayment. So another exception wherein the insured person may recover on his premium payments made so far to the insurer. Section 82 provides that when the contract is voidable because of the existence of facts of which the insured was ignorant of without his or her fault. So this provision entitles the insured person to recover on the premium payments. So illustration, where the insured pays insurance premiums on his vessel, not knowing that it has already been lost. He can recover back the premiums so paid in the absence of stipulation in the policy that the insurer will remain liable even if the vessel is already lost. So I guess that's understandable from the illustration itself. Now, One of the exceptions also is when the contract is voidable on account of the fraudulent inducement or misrepresentation made by the insurer or his agent. So, an example would be where the insured is induced to take out an insurance upon the representation of the insurer's agent that the policy will be issued to him within 1 month. The insured may refuse the contract and recover back the premiums paid by him if the policy is not issued within said period. So this particular provision or exception entitles the insured to recover when he has been induced through fraudulent machinations or misrepresentation made by the insurer himself or his agent, which induced the insured person to take on the insurance policy being offered to him. So Section 83, in case of an overinsurance by several insurers other than life, the insured is entitled to a rateable return of the premium proportioned to the amount by which the aggregate sum is insured in all the policies exceeds the insurable value of the thing at risk. So this particular exception wherein the insured person may recover on his premium payments is easily understood upon first reading of the provision. Now, let's proceed with the illustration. Suppose X insures his house which has insurable value of 1.5 million pesos as follows. So he insured it with a corporation in the amount of 1.2 million and paid premium of 24,000. He also insured the same with B Corporation in the amount of 600,000 and paid premiums of 12,000. Now notice that the aggregate insurance value that X had entered into exceeds the insurable value of his house by 300,000, no? That is 1.8 million minus 1.5 million. And then to get the rateable return of the premium, we divide the overinsurance amount by the aggregate sum of the insurance value. That is 1.2 million plus 600, 1.8 million. So 300,000 divided by 1.8 million pesos, we arrive at 1/6. Now this 1/6 represents the rate of return of the premium that the insured person is entitled to on each of his premium payments made or paid. So we just multiply the rate with the premium payments, and the value or the product or value is the amount that he is entitled to recover from the insurer he has availed or took out a policy on. So I guess that would be for overinsurance as an exception to the rule. Now we have this caveat. No, recovery of premiums paid is not allowed in life insurance if the insured surrenders his policy. However, the insured will be entitled to receive the cash surrender value of his policy after 3 full annual premiums shall have been paid. Now, what's the reason why it is not allowed in life insurance policies? The reason would be life insurance policies are not a divisible contract. They are not an insurance for a single year with a privilege of renewal from year to year by paying the annual premium, but that it is an entire contract of insurance for life subject to discontinuance and for future for non-payment of any of the stipulated premiums. There is no proper relation between the annual premium and the risk of assurance for the year in which it is paid. Each installment is in fact part consideration of the entire insurance for life. It is the same thing where the annual premiums are spread over the whole life. The value of the insurance for 1 year of a man's life when he is young, strong, and healthy is manifestly not the same when he is old and decrepit. So, for the last section of this particular title, we have section 84. An insurer may contract and accept payments in addition to regular premium for the purpose of paying future premiums on the policy or to increase the benefits thereof. So, this particular provision is actually in conformity or supports the mutuality of contracts principle under this jurisdiction, which basically allows for the uh, primary parties in the insurance contract, the insured and the insurer, to stipulate to make such stipulations as are not so long as they are not contrary to the law, morals, public policy, customs, etc., etc. So yes, they can provide or they can stipulate that aside from the regular premium to be paid by the insured person, an additional amount may be paid by him no, for the purpose of paying future premiums on the policy or to increase the benefits thereof. So note that the insured is duty bound only to make prompt payment of only the insurance premiums due under the policy. Now this does not include the additional amounts that under the stipulation have been under the stipulation to be paid by the insured person to the insurer under the policy. So I guess that would be all for this for Title 8 of the Insurance Code, which speaks of premiums. Thank you and Assalamu alaikum.